Somewhere right now, a man is signing a piece of paper. He doesn't know it yet. But that signature just committed the next 6 years of his income to a machine that loses value the second he drives it off the lot. He'll call it a smart purchase. The bank will call it a performing asset. And in 6 years, he'll do it again. This isn't a story about cars. It's a story about a financial habit so normalized that breaking it feels strange, almost suspicious. Because here's the uncomfortable part. The average new car payment in America just crossed $700 a month. Not the price of the car. The monthly payment. And the average loan term has stretched past 6 years, creeping towards 7, because that's the only way to make the payment feel survivable. Most drivers trade in before the loan is even paid off. Which means most people are never actually driving a car they own. They're driving a car they're renting from a bank, dressed up to look like ownership. So what happens if you just stop? What happens if you take the same car, the one already sitting in your driveway, and you simply keep it? 10 years. No upgrade. No new car smell. No trade-in. That question sounds boring. It is not. Here's why this matters right now, more than it did a decade ago. Car prices have outpaced wages for 15 straight years. Interest rates on auto loans have doubled since 2021. And household auto debt in the US just hit a record high, over $1.5 trillion. People aren't buying more cars. They're paying more for the same cars, for longer, at higher interest. The system didn't get more generous. It got more patient. And patience, in finance, is just another word for compounding against you instead of for you. So let's break down what actually happens to a car, financially, from the moment you buy it. A new car loses roughly 20% of its value in the first year alone. Just driving it off the lot. By year 3, it's lost close to 40%. This is depreciation, and it is brutal, predictable, and completely ignored by most buyers in the excitement of a new purchase. Here's the part nobody puts in the commercial. The auto industry doesn't actually need you to buy a car. It needs you to keep buying cars. The entire business model, manufacturers, dealerships, lenders, is built around a replacement cycle. New model. New loan. The car is the product, but the loan is the business. Trade it in every 5 to 6 years, like most people do, and you are perpetually buying during the steepest part of the depreciation curve. You're paying full price for the years a car loses value the fastest, then handing it off right before it becomes cheap to own. It's like buying a new pair of shoes every time the soles start to wear in, instead of just replacing the soles. Now here's the math nobody shows you, because it's not exciting enough for a commercial. Say a car payment is $600 a month. After the loan is paid off in year 6, instead of trading in for a new one, you keep driving it. Same car. Maybe a few $100s a year in extra maintenance. For the next 4 years, you take that $600 a month, the payment you're no longer making, and you simply invest it instead. At a modest 7% average return, that's not just $28,000 saved. It's closer to $33,000, because the money was working the whole time, not just sitting there. Now stretch that habit across 10 years total instead of 6. Across a working life of, say, 40 years, where every other person trades in every 6 years and you trade in every 15. The gap isn't measured in thousands anymore. It's measured in a different life. A paid-off house earlier. A retirement account that compounds for decades instead of getting interrupted every 6 years by a new loan. The decision around the car did. And that decision was worth more than most people's salary increases over the same period. Here's where it gets uncomfortable, though, because the math is the easy part. The harder part is the hype. New cars are not sold as transportation. They're sold as identity. A new car says something. It signals progress, success, momentum. The old car, the one with 200,000 kilometers on it, says something too, just not the thing anyone once said about them at a stoplight. So people upgrade not because the car stopped working, but because the story it tells stopped feeling good enough. And that's the real transaction happening. Not metal for money. Status for debt. The irony is sharp if you sit with it. The person driving the 10-year-old paid-off car, the one who looks, on the surface, like they're falling behind, they're often the one quietly building the financial position everyone else is performing. Zoom out, and this stops being a story about cars entirely. It becomes a story about how an entire economy is structured to monetize impatience. Phones, fashion, kitchens, cars, replaced not because they failed, but because the next version arrived and made the current one feel unacceptable to keep. The car is just the most expensive, most visible version of that pattern. It's the one with a contract attached. A signature. A 6-year sentence, repeated, quietly, for most of a working life. And the people who break the cycle don't look wealthy. They look, frankly, a little behind. Driving something a few years out of date. Not upgrading when everyone else does. But wealth was never about what you're seen driving. It was about what you stopped paying for. So here's the question worth sitting with, long after this video ends. If the car in your driveway right now could last another 5 years, and you let it, what would you actually do with the money you didn't spend replacing it? Would you invest it, save it, or would you simply find something else to spend it on, because the habit was never really about the car at all?